Understanding your financial ratios. Have you went on a physical health check before? If you have went on a physical health check before, you will receive a physical health check report that gives you readings such as your cholesterol, your BMI, your blood pressure, etc. and etc. There is also a financial health check that you can go through. By going through a financial health check, it gives you a measurement of the state of your health. There are essential financial ratios that we ought to take note of. Basic liquidity ratio is when you get your liquid assets divided by your monthly expenses. Liquid assets refers to assets that are easily convertible to cash without significant loss of value. The recommended guide that we ought to have is 3 to 6 months of your monthly expenses. If we have too much liquidity ratio, it is also not very healthy. It's because our money or your money is not working hard enough for you. Savings ratio is when we get our total savings. That means to say that whether is it from your income, from your dividend, from any other sources coming together, divided by your net cash inflow, the net cash that you receive at hand. The recommended ratio is at least 10%. What do we mean when we save 10% of your net cash inflow? Or essentially, to make it simple, 10% of your income. It means in 10 years of your working life, after 10 years, if you were to adopt this saving habit on a consistent measure with 10% on a monthly basis, after 10 years, you only have 1 year of your income. Just imagine if you are only saving 5%. After 10 years, you only have 6 months of your income. Non-mortgage debt service ratio. This ratio provides an insight into what amount of income is going towards non-mortgage debt. Non-mortgage debt such as your installment, your car loan, your renovation loan, your personal line of credit, etc., etc. Divided by your total monthly take-home pay less your CPF contribution. The recommended guide is less than 15%. If you have more than 20%, you are treading on dangerous ground. Do take note. Finally, mortgage servicing ratio. This ratio reveals to the percentage of your gross monthly income that can be used to service your monthly property loan installment. The recommended guide is actually less than 30% of your gross income is being used to repay your property loan. Given that recently there are property measures that come down, in the past you can use 40% of your income to pay for your mortgage. When it comes to your HDB loan, it has been lowered to 35%. If you were to borrow from the bank itself, they have a cap of 30%. So conservatively, we ought not to use more than 30% of our gross income to repay our property loan.